Hey there! Are you an ordinary person looking for a way to invest a few $100s in the stock market, expecting that it will grow over time, but don't really know how, where, or what to start with? Don't worry, I have got you covered. In this video, I will be teaching you the right approach to invest in the stock market and how you can avoid risk and make millions of dollars worth of return on your little investment. So please, don't skip and watch the video till the end. I promise you will not regret it. But before that, please like this video because it really encourages me and my channel to grow. I will be covering key concepts of the stock market and answer the most frequently asked question of a newbie. The points we are going to discuss today are how risky is the stock market, how to set up a stock trading account, how much investment to start with, what should be your expected ROI, how to calculate tax implication, how to pick up the right stock, why do share prices fluctuate, and how to think positive and keep yourself motivated. For your convenience, I have added timestamps so that you'll be able to jump onto your desired section of this video anytime you want. So how risky is the stock market? When you are buying a share, you are becoming a partner in that company. Let's take Apple Incorporation for an example. You are investing in Apple share thinking that shares will reach $1,000 in upcoming days. But unfortunately, it turns out Apple shares are not doing well in the market. As a result, you are not going to get your desired profit. On the contrary, if Apple's shares are growing and exceed your prediction, you will make millions with it. As Warren Buffett, also known as the Oracle of Omaha, says, if a business does well, the stock eventually follows. For the investor, a too high purchase price for the stock of an excellent company can undo the effect of a subsequent decade of favorable business development. So the idea is to invest in the stock market while keeping in mind that you might face profit or loss. Either way, you need to prepare your mind and always be ready for it. So investing wisely is crucial. And yes, there are high risks involved, but there are high ROI as well, and there are also many ways to reduce the risk, which I'm gonna explain later in this video. Setting up a stock trading account. The process is fairly simple nowadays. Everything is online. There is no minimum opening account, so you can casually open up an account and put $1 and start trading. It's super easy. And besides that, you have an option to open up a robo-advisor account. With this, you can passively invest without having to buy or sell individual stocks. Two great options for you guys are Sophie Automated Investing and Betterment. They are really incredible overall and one of the best robo-advisor out there. You can find the links in the description box below. Disclaimer: this is not a sponsored video. Sophie Automated Investing and Betterment, neither of them are sponsoring this video. This is my personal recommendation. Moving on. There are no minimum for opening up an account, so it's literally super easy to start off with this. To open an account, though, there are a few paperwork and requirements. First thing you need to do is go to your desired website and submit an application form. It literally takes a minute. After that, you are gonna need to fill up the application form with some personal information such as SSN, address, name, DOB, etc. and etc. Moving on. Pick your desired username and password, verify your identity, usually it means two-factor verification, wait for the application to be approved. It should be pretty quick. And once that's done, fund your account, put some money into it, and start trading. Now you might be thinking, how much investment to start with? Well, to answer that question, I recommend starting off with the extra money you have after all your expenses. Invest slowly and gradually and understand the market first. By doing so, you are reducing the risk of you hitting the rock bottom and eventually gain excellent ROI. Just because you have just received your paycheck in your bank account doesn't mean you are supposed to pour all that money into investment. That's a big no. It doesn't work that way. And if you go all in, you will have to pay the price, my friend. So the next thing we are going to talk about is what should be your expected ROI? As a matter of fact, it's a very important and tricky question as well. Because there are no fixed ROI on stock market. When you invest $1,000 in a business, you might get 10%, 30%, or even 50% return out of it. So there is no fixed formula for it, and because the market is so unpredictable and ever-changing, you need to allocate your investment across different financial instruments, industries, and other categories. It aims to maximize return by investing in different areas that would each react differently to the same event. This is called diversification. I recommend investing in at least multiple company shares so that if one or two companies face loss or goes bankrupt, you will have other companies to rely on. This way, you can get 10 to 15% of return in at least 10 years. But you need to pick stocks wisely. For an example, let's say you are investing $1,000 each month in the first year. You need to make sure you are going to increase it by 15% in every year, which means year 1, you will get $12,000. Year 2, you will get $13,800. Year 3, you will get $15,870. Year 4, $18,250. Year 5, $21,000 approximately. Let's say you will get at least 15% return on investment since you started with $1,000. And in 25 years, you are gonna get around $10 million. As Warren Buffett said, capital preservation should be the main priority for any investor when deciding to place your money into the market. It basically says not to be stubborn in the market. So the key takeaways are, you need to increase 15% on your investment each year. You need to keep investing 5 to 25 years in the market. And you need to get at least 15% ROI. The next thing we are going to discuss is tax calculation. It's a very important and crucial part of any investor. The straight answer to this question should be, it depends on when you are selling the stocks or how long you keep the stocks before selling. If you sell stocks after 1 year, the tax implication is gonna be 0%, 15%, and 20% depending on your income level. Now, if you sell stocks within a year, it can be any month, 1 month, 3 months, 6 months, 9 months, etc. You will be charged a regular tax. So the bottom line is, holding stocks over 1 year will result in less taxes. Now comes the golden question, how to pick the right stocks. Remember, company research is your friend. In this part of the video, I will share some basic research techniques to pick the right stocks for you. We are taking Tesla as an example to illustrate this. Number 1. Profit growth. Find out if Tesla's profit growth is going upward, downward, or it's steady. For an example, let's say Tesla's profit growth is increasing every year. Year 1, 10 million. Year 2, 15 million. Year 3, 20 million. Year 4, 25 million. You get the picture. As a result, you can buy its shares because the more Tesla profits, the more its stock's price are gonna go up. Number 2. Debt to equity ratio. Look into Tesla's annual report to find out its short-term and long-term loan amount. The less debt amount, the more chances of it to survive in the long run, which makes it safer. Number 3. Portfolio diversification. Make sure you spread your risk by diversifying your portfolio, which means you simply need to invest in different company stocks at a time. Number 4. ROE, return on equity. When you buy a share, you become that company's equity holder. So find out how much return on equity Tesla has been bringing back to its shareholders. If you are expecting 15% ROE, you need to make sure that Tesla is capable of bringing 15% or more return to its shareholders' investment. Number 5. Competitive advantages. You need to know what makes Tesla different from other car manufacturers. In our case, Tesla is an electronic car manufacturer, which makes it different from other car manufacturers. In addition to this, it has a bunch of special perks such as it can drive by itself, etc. and etc. Number 6. Avoid emotion. When making investment decisions, do not simply buy stocks because there is a hype around it. And do not rush into any buying or selling decisions. Why do share prices fluctuate? It really depends on the company performance. There are various reasons that can affect share prices to rise or fall. Causes of price rises: board of directors buying shares, increase of manufacture, global recognition. Share price increases when a company announces that it's going to do well in the upcoming future, or it is going to provide bonuses and incentives or write shares, etc. Causes of price fall: board of directors selling shares, controversy or legal conflicts, etc. How to think positive and keep yourself motivated. Let me put it this way. If you are interested in buying shares of a company, first thing you need to research, and research. You need to research about 3 things. Know why you are investing in that particular company, who are the owners and managers and shareholders, etc. and etc. and what shares are you investing in. People tend to jump into share market and start buying shares of a company without properly researching it. A piece of advice: don't listen to other people and rely on their words and rumors blindly. Trust your research, believe in your senses, and invest wisely. So that's it for today. Hope you enjoyed this video, and if you did, please leave a like and don't forget to share and subscribe. See you in the next video.